bond and bond funds. A lot of people, actually in Singapore, a lot of people are not familiar with bonds or bond funds. And I can tell you there are some reason why a lot of people, they don't invest in bonds, or rather they don't know there is a bond investment. Okay, reason because we have these 6 options that you can use to invest in bonds. Okay, and I can tell you that the first 2 right now you can probably ignore, because these 2 is like less than 1% return already. It's just like saving. Okay, so these 2 is not really, to me, of course they will provide certain income, but that should not be used for long-term investment because it's very low return. Okay, so first 2 is out. Okay, option 3 and option 4, yes, you can invest. Okay, but option 4 got one problem: minimum investment 250,000. Okay, so unless you have like few $1,000,000, then it makes sense. Okay, if you only have 250,000, right, you also don't want to buy just one company bond. Okay, then end up you every day just watch a bond, make sure they don't collapse. You should not do that as well. Okay, so option 4 for most people may have the issue with the capital. Okay, option 3 is just like stock. You can buy minimum 1,000. Okay, but the problem for this retail bond is very limited selection. Okay, later on I saw a slide, you can see that only about 10 bonds for her to choose. Okay, 10 bonds only. Okay, and those bonds, either they are very low return, or either they are very high risk. So it's not much, there's not much option for to choose as well. Okay, so that's why most people, if you ask me as a retail investor, we either go for bond ETF or bond funds. Okay, and I'll tell you some key criteria I use to select these bond ETF and bond funds. Right, you can do it on your own. If not, you can ask me to invest for you. Okay, there are a few ways to do it, right? So let me just show you a limitation on retail bonds. Okay, it's just like stocks. As long as you have a trading account with any brokerage account, you can buy this bond. But problem is, you can see these are the bonds. Okay, probably the more famous one recently, probably last year, is the Astral, which is so-called the private equity fund from Temasek. Not risk-free, not 100% risk-free. Okay, but still a lot of people, they buy. It's fine. Okay, that will give you a 3 to 4% kind of return. Right? But right now you can see you actually have to pay higher than $1. Okay, meaning you are paying on premium. On premium, meaning you pay more. Okay, that means your return will be less than this percentage. Okay, less than this percentage. All right, because you pay more, but you only get 4.35%. So your return definitely less than this amount, right? And the rest, you can see all these, okay, maybe Fraser Property is still safer one. City Development can be safer one, right? CapitaLand, of course, is safe, right? But you can see the return is really like 3% kind of return. Actually lower than 3% because you pay more, okay? Then the other option is like, Hyflux is like almost default rate. You can't buy. Banyan Tree, I also don't know whether you should buy because 7% is very high risk, right? So the problem is, if you want to buy direct bond, you want to invest in direct bond, right? You have limited selection. Okay, that is the problem on why you can't buy direct. Okay, and of course, if you have more money, you can go for OTC bond, right? You just call your broker. Okay, if you're a broker, just call me. We can give you a list of bonds with more than 50,000, and that a lot of options. I think about 1,000 over bonds for you to choose. Okay, the only problem is usually the person may not have sufficient capital to pick up all these bonds, right? So that is why you will come to either a bond fund or bond ETF for your layer 3. Okay, so okay, I start with bond ETF. Okay, bond ETF is just like any stock, okay, any ETF listed on global exchanges, right? There is also active and passive bond ETF. Okay, but most of the time when we talk about ETF, they are passively managed, meaning they just follow the bond index. Okay, there are some issue with bond ETF. Okay, personally, I don't buy bond ETF. I buy bond funds. Okay, reason because for bond ETF, whenever you want to buy and sell, there's a bid and ask. Okay, the buy price and the sell price, right? So the buy price and sell price might be very wide. Maybe, for example, you buy $1, you may have to sell at, let's say, $1.05. Example. Okay, so this is we call the spread. Okay, it can be quite wide. In this case, it's 5%, right? So that will be an issue if you want to buy and sell bond ETF. Okay, liquidity issue. Okay, sometimes if you want to buy, nobody sell to you. You want to sell, nobody want to buy to you from you. Okay, so that's why that could be a problem for bond ETF. right? And also lower expense ratio for bond ETF, because ETF, there's a fund manager to manage the bond, so definitely there is a expense. There's an expense. Okay, it's just that usually ETF will have slightly lower expense than other bond funds. Okay, higher expense ratio for those active bond ETF, which I don't think a lot of them, right? You can use ETF screener, okay, to screen out the bond that you want to invest. I can show one ETF screener. Okay, it's actually on Poems. Let me show you. Okay, I believe, I'm not sure whether you have Poems account. Okay, if you don't have, you can just open one account with me. Okay, let me just share my name card. Okay, forgot to share my name card. Okay, I just share how to open Poems account. If you want, you can open with me so that I can access to this screener. Okay, so go to ETF. Okay, I'm showing you how to find ETF, bond ETF. Okay, you can just go to any ETF. Just go to any ETFs, whether Singapore, overseas is fine. Just right click on any of them. Then you view details. Okay, that will give you ETF screener, the page ETF screener. Right, and of course, this is just an example. So, and turn out that this is a bond ETF. Okay, but if let's say you go to any ETF, so now it's not bond ETF, right? What you can do is you can just click back to screener. Okay, then you will come to this page called ETF screener. Okay, and this is where you can do a screening for all the bond ETF around the global market. Okay, you can say that, oh, asset class. In this case, I want fixed income. Fixed income meaning bond. Okay, and you can select a reason. Okay, if you don't want just I mean, maybe you want, you can just go for global, right? I'm not sure whether I got global here. No global. Okay, no global, then don't select. It's okay. Yeah. So these are all the bond ETF that you can invest, right? You can go to some fundamental to see whether they pay dividend on monthly basis. You can even sort it out based on dividend yield, right? Like this one actually give you 10% payout. Okay, but don't buy just because of highest dividend. All right, you must really understand the risk behind. So if you really want to know what are they investing into, you have to click the name, right? Then you will come to the page on what kind of objective, right? And also what kind of the portfolio, meaning what kind of holding they have. And in this case, they are holding a lot of preferred, right? Preferred share. So it's not really bonds in this case. They hold a lot of perpetual, right? So of course, I usually don't like to do a perpetual bond. So yeah, so this one you might want to skip, okay? Because this will be all more on perpetual bonds, perpetual and preferred share. It's not really bonds, okay? Yeah, so you can even see the country exposure. Okay, like this one a lot into US. So what you need to do is just have to do the screening to pick the bond ETF that you want to invest. Okay, with the view that you are looking at. Okay, I would say for a good reasonable bond yield is about 5 to 6%. Okay, this is on the higher side of risk, higher risk. Okay, if you want mid risk one, maybe around 3% to 4%. Okay, and anything lower than 3%, I think it's more like a saving to me, right? More like short-term saving. Okay, so I think for retirement planning, usually I'll go for this target yield, right? Perpetual meaning no maturity. Okay, the bond that the ETF investing in will hold forever. Okay, okay. So why bond? To me, why bond is safer than equity and than stocks, right? The reason very simple. Okay, so usually bond will start with $1 during IPO, $1. Okay, and you know every single investment will always go up and down, go up and down. Okay, it can be a time that, you know, because of market crash, the price drop and then it go up. Okay, but when come to the bond maturity, right? This is called maturity. Okay, it can be 3 years, it can be 5 years, it can be 10 years. Okay, but when come to maturity, this price, right, will always go back to $1. Right? Reason be very simple. If the bond price never go back to $1, let's say go back to like 80 cents, okay, then if I know that this bond is going to mature tomorrow, right? If the maturity is like 1 day later, right? I will buy this, and then next day I'll get back $1, which is impossible, right? There's no free money in the market, right? So for sure, the bond price will always go back to maturity level if the bond is able to mature, right? And if there's a maturity. Okay, but without this maturity, right, then the bond price will just fluctuate just like any stocks. Okay, there is no chance that the price may go back to $1. So I don't like to buy perpetual bonds because of this reason. Okay, a bond is a wider topic. Okay, I try not to touch on how to analyze individual bonds because usually you also won't have chance to buy individual bonds. Okay, there are so limited option. Okay, yeah. So that is a bond ETF. Try to screen for those that within this range, and then look on the underlying. Make sure you are comfortable with the risk. All right, no problem. All right. So okay. I actually prefer a bond funds, okay, because bond fund is over the counter, OTC meaning over the counter, not listed on exchange, right? Meaning you can do a direct subscription and redemption from the fund, and there is no issue for you that you cannot buy, you cannot sell, because if you want to buy, you just put the money, then the fund manager will create new units for you. So for sure you can buy, you 100% liquidity, I think, no liquidity issue and no bid and ask issue, okay. The fund will be in NAV, only one price. You buy and sell based on the same price. So there is no bid and ask problem, and also there is no problem for you to buy and sell, because if you want to buy, for sure you can get it. You want to sell, for sure you can liquidate. Okay, so that is the advantage of using bond fund instead of bond ETF, right? And of course, bond fund usually is actively managed, so they have a slightly higher expense ratio. Okay. Dividend option, you can choose reinvest or payout, but usually we go for payout because you want to have cash flow for retirement. You also can choose monthly payout. Like I mentioned, retirement planning, you want something that pay out more frequently. Okay, so we usually go for those monthly payout funds because you want to receive a monthly dividend. Okay, you don't want once a year they pay to you, then within next 11 months you don't have any money to spend, right? Yeah, so that is the advantage of why I prefer bond funds, because I don't have to worry, cannot sell, cannot buy, how much to buy all this, I don't have to care all this, right? How I select, right, selection criteria for all these bond fund or bond ETF, right? Mainly fixed income exposure, because I want bonds. Okay, I don't want a lot into equity, because equity I can buy direct dividend stocks, I can buy direct equity funds. Okay, so I don't want to buy bond fund with ETF with a lot of equity exposure. Okay, so mainly bond exposure, that is number one. Okay, number two, I want short duration. Okay, and this will come back to the same picture of this maturity. Sorry, this is a maturity, and this is like the issue date, the IPO date. Okay, so like I mentioned, $1 bonds will fluctuate and then it go to maturity. Okay, so this period, right, okay, is the duration, okay, or the holding period of the bond. Okay, I want this as short as possible, because if you go into the bond that can mature, let's say 2 years later or 1 year later, okay, so the chances of this fluctuation will be smaller, right, and it will go back to maturity in a shorter period. Okay, and once the bond mature, right, technically you don't have risk already, because the money go back to the fund manager already, go back to the ETF or go back to the bond funds, right? Yeah. So when the bond matured, it go back to the fund manager, meaning the risk is of course the money will reinvest in the new bond, but that gives the fund manager a chance to rebalance the portfolio. That's why I want to have low or short duration. Okay, and also less sensitive to interest rate, because every time matured, they can look for new bond to invest. Okay, so that is one of my key selection criteria. All right, that's why I don't like perpetual, because perpetual meaning forever. I mean the duration is lifetime, right? So I want choose the bond fund with a good track record on dividend history. Okay, so you can actually look at the dividend history, make sure it's consistent. Okay, of course, track record is one thing, but we cannot ensure that future performance is the same, but at least that will give you some guideline, you see. Okay, if you can do well in the past, hopefully you can do well in the future. So that is one of the key criteria when I select. All right, and this is probably one of the main things you should focus. The yield to maturity must be more than dividend yield. I'll explain later when I show the example. I prefer high yield and short term, okay, or low yield with long term. Okay, like I mentioned, if you want high yield, that should be about 5 to 6%. I think in the market, this market is possible. If you want to go for, I call mid yield, I don't use the term low yield. Okay, you should look for 3 to 4%. Okay, so for high yield, right, typically the duration should be less than 3 years. Okay, that is my criteria. Okay, because high yield itself already risky, I don't want to hold long term. I don't want the fund manager to hold for long term for me. So I usually look for less than 3 years kind of maturity. All right, and for mid yield, I want to be longer term. Okay, more than 5 years is fine. Okay, because mid yield itself is already lower risk, right? So lower risk, if you still look for short term, right, your yield will be very slow. Okay, so we want low risk, but we are okay to hold for long term because low risk you can hold for longer term. Okay, and the longer the term that you choose, right, you can get higher return. Okay, that's why low yield, long term, high yield, short term. Okay, so that will be so-called my main selection criteria, right? I mean, these are all the example. Okay, I probably need to remove some. Okay, let's say this is a fund statistic example only. Okay, so usually for this one bond fund or bond ETF, right, they will show you this fund statistic. Okay, and what you need to focus, one thing is of course the weighted average maturity. Okay, in this case here is 1.8 years, right? Yeah, so this is a short term. Okay, and you can see this yield to maturity, right, is about 7.39%. So this is high yield, right? Yeah, so this will fulfill my criteria, high yield and short duration, right? But of course, 7.39% is the yield that go to the fund, right? Go to the fund. The fund manager definitely will not pay you 7.39%. They'll pay you slightly lower, maybe 6%, maybe 5%. Okay, as long as they pay me slightly lower than this yield, I'm okay to invest. Okay, because I know this 6% come from the yield that they receive. Okay, I don't want they receive, let's say 5%, then they pay me 6%. I know this 6% that they pay to me is not going to sustain, right? So I want the yield to maturity higher than the dividend yield. That is why I mentioned this point number 4. The yield to maturity of the funds must be it must be higher than the yield that they pay to you, right? Yeah, so that is one of the key selection criteria to ensure that the dividend is sustainable. Okay, regardless of whether you use bond fund or bond ETF, this will be my way to select the funds. Okay, it's a bit complex because you need some knowledge to select a good bond fund, right? Any question so far? I thought this would be one of the key topics, key reason why you attend this workshop, because I don't see a lot of people share this concept about bond investing. Okay, a lot of people they don't understand bond investment. So I hope this is beneficial for you, right? Where to look for bond fund? Oh, sorry, I think okay, good question. Where to look for bond funds? Okay, got three. Actually, got few methods for to buy bond funds, and also for to select bond funds. Okay, one is of course you can do it on your own. Honestly, if you have all this knowledge, you know how to pick. Go ahead and pick on your own because you actually have a lowest transaction cost. You can buy online on Poems. You pay 0% fee. If you know how to invest, you just go to Poems. Okay, ETF, of course, you go to ETF, like I mentioned, ETF screener, you screen out. Let's say you want to buy this, right? Example, you want to buy this, you then just type the code, right? I think should be either PFFA. Example, you want to buy this. Okay, you just, after the screen, you just buy. Yeah. So just right click and buy. Right. So that is how you select ETF and how to invest on your own. Okay, and of course ETF, the usual transaction cost apply like normal buy and sell cost, right? So that is the lowest cost you can buy ETF. Okay, unit trust, if you want to, I mean bond fund you want to find, you can also find on Poems if you want. You can screen asset class, fixed income. And of course, you can screen the country. Okay, of course, usually I go for global. I don't want to take a country risk, so I go for global. Right, and also usually I want just Sing dollar. Right, so these are all the bond funds that you can buy on your own. But there are so many of them. So how to pick the right one? That requires certain I mean, one way you can do is you can screen based on highest return, right? But that probably you still need to do some research. Okay, for example, you screen out and this will give you 6% per year over the last 3 years. Then what you need to do is you have to create the fund fact sheet. Then you have to interpret the fund fact sheet number. And also you have to use a criteria that I share with you: high yield, short duration, low yield, long duration, and to assess whether is it a right bond fund for you to invest. Yeah. So I think this one is a low yield, high long duration. Yeah, correct. Low yield, long duration. All right. So it's a safer fund for this one. Okay. So if you look at it, I'm okay with this, then you can invest. Okay, but I think this one will not give you a lot of dividend because the yield they are getting is only 2%. I think likely you get 1+% payout only, right? But it's very safe because based on the yield, right? Yeah. So that is how you select. Okay, you just have to look for individual funds and then look for the fund fact sheet. Okay, and based on criteria to pick, right? That is how you can do it on your own. Okay, you must pass CAR-CKA. Just go to account management, right? There is a CAR-CKA page, okay, to make sure you are qualified to invest on your own, right? That is how you do it on your own. But if not, of course, you can engage a professional advisor like me, example, right? You can go through advisor, banker, or broker. Of course, different broker, different platform will give you different charges. Okay, for me, I go for 1%. So of course, if you want to do all this homework on your own, then you just follow the advisor advice to pick the bond fund for you. And this is called non-wrap account, meaning every time you switch, there's a switching fee, right? Which I personally don't really like to have this arrangement. I actually want to have the other arrangement called wrap account. Also 1%, but there's a wrap fee, meaning advisory fee. But there's an ongoing monitoring and reporting and also free switching. Okay, so most of the clients actually come to me is actually under this structure. Okay, because I will be the one to pick for them, I'll be the one to monitor for them and also report to them every month. Okay, yeah. So a lot of people, they don't want to pick on their own; they just come to me to get the bond funds for them. All right, because I personally also invest on my own. So these are the 5 bond fund and multi-asset fund I invest in. I think a lot of you actually seen this every month for my monthly slide. I'm getting 6% payout per month. I mean per year, sorry. So every month I'm getting $886 for my investment. Okay, I put in 180,000. Every month getting about $886. Okay, for my link of income. Okay. Yeah. So I track my monthly income. Make sure it's consistent. Okay, make sure don't fluctuate too much. Right. That is how I create my third layer of passive income. Okay, so if you like to, I mean, if you want me to help you to pick up this portfolio, you can just let me know. Okay, at the end of this workshop, there's a QR code. You can let me know you are interested. Then I can arrange a session to create this third layer of income for you. Right. Okay, let me address some of the question. Benedict asks, is it what is perpetual? Where to look for bond fund? Okay, I will explain. Is there any bond fund screener like EDF to check yield to maturity? No, unfortunately, you don't have that yield to maturity. Okay, actually, for us, we have as advisor, we have more resources. We do have an Excel spreadsheet that come from our research house. So they actually have a screener for us to rank based on yield, based on the dividend yield. But unfortunately, that one is only for internal circulation, so I can't share this with you. Right. So for us, actually we have additional tool to actually rank it based on the yield, and then we can pick those bond to invest. Right. Yeah. So sometimes if you find that it's justified for you to get advisor to do it for you, make sure that you get them to do it for you. Okay? If you do it on your own, you are going to spend a lot of time to do it on your own research. Okay. So this is for our advisor in Phillip to have this list. Right. And let me answer 2 more questions. HY and 1Y range is referring to yield. Yeah, it's yield to maturity or dividend yield. Okay, I think Benny, you're referring to this. Okay, this is the actual yield that you want to receive. Okay, yeah, so I'm referring to the actual yield. And any differences to junk bond in US to bond funds listed in SGX? No difference for Sharon, your question, no different. Okay, the list whether they list on US or Singapore is just where they list only. Okay, to me, it's more about the underlying bond they are investing in. Whether they are junk bond, investment grade, non-investment grade, that will determine whether I should invest or not. Not about which country they list or whether they are listed or they are OTC bond funds. Okay, that one to me not really a key consideration, right? I have Singapore bond bought through ATM. How should I hold and how to sell? Singapore bond hold through ATM. I think you are referring to Singapore saving bond. That one you have to sell through ATM. Either sell through ATM or you sell through your banks. Okay, you have to check with them. Okay, because this kind of bond is called Singapore saving bond, right? Only in your CDB account. You can't sell through brokerage account. All right. 6% is net of fee or gross. Net of fee, okay, this is my own portfolio. And the stupid thing is I charge myself for the advisory fee, which I don't have to, right? So the 6% actually my payout net of fee. Okay. But again, I cannot say guaranteed payout. It's just based on my track record, I'm able to get 6% payout. Right?